Right, everyone, in this video, I'm going to teach you how to build a complete Forex fundamental analysis trading strategy from scratch. Now, this is the exact same process that I've taught to many other traders, and they've been able to turn £5,000 into £25,000 or £1,000 into £12,000 just by understanding exactly how fundamental analysis actually works. So this isn't going to be your basic technical analysis video with meaningless chart patterns and indicators, okay? I'm going to be showing you exactly how to analyze the Forex markets using fundamentals so you can finally stop gambling with your money and start trading with an edge. As this video is going to give you the exact step-by-step process for you to follow so you never ever have to watch another trading video again. So guys, let's get into it. Firstly, let's look at some hard facts and data that proves why technical analysis traders always end up losing their money in the Forex markets, okay? Now remember, these are real stats and real numbers that prove why technicals don't work. So 40% of technical analysis traders quit within 1 month, okay? And if you survive the 1 month, 80% end up quitting within 2 years. And then 93% of technical traders end up giving up within 5 years. And if you've got this 7% left that are still trying, they will end up giving up anytime after 5 years. It won't be long because you're not going to keep giving your money to the markets without making some profits before you give up. So let's look at why your mindset needs to shift away from technical analysis if you want to become a profitable trader. So let's think about this logically. When you're trading technical analysis and you're looking at candlesticks on a chart, I don't care if you're trading 5-minute charts, 15-minute charts, 1-hour charts, 1-day charts. The candlestick doesn't give you any information about why the markets had moved in the past, okay? So you're looking at a chart and you're trying to then guess the future for where the currency pair is going to move next, but you have no information within the candlestick you're looking at that explains why the currency pair moved in the past. So you're basically trading blind and gambling on where the currency pair is going to move next with no fundamental knowledge or any information that can help you predict the future. And this is exactly why technical analysis traders get stuck in what we call the death cycle, which means you find a strategy, you then do some back testing on the strategy, and you think, oh, this looks like it can work. But when you try to implement the strategy into the real live markets, again, this back testing never told you why the markets moved at that period of time. So when you try to implement it in the live markets, you end up failing. You blow your trading account, you get super frustrated, you give up your strategy, you search for another strategy, and the cycle continues. Now, in the comments, tell me if I'm wrong. Doesn't sound familiar to you? Are you ever in a trade and then suddenly a currency pair just spikes, hits your stop loss, and you're there thinking, what the hell happened? And then you realize some news came out and the markets reacted to the news, and the news ended up making you blow your trading account. Or something happened in the news, the currency market spiked, you then tried to jump into the trade, and then the markets then go straight back down after the news came out, and you think, well, why did it spike higher then come back lower? And you feel super frustrated because if only you understood the news, you would fundamentally understand why currencies were going up or down in value. So what you need to understand is that fundamentals is like the foundation of a house. It explains and it supports why the markets moved. And without this foundation, your house, which is your trading account, will always collapse. So this is why we call it the technical analysis death trap, because no technical analysis strategy ever explains to you why the markets fundamentally move. So you end up jumping from strategy to strategy with all the other retail traders. So the first thing we need to do is completely shift our mindset and start to focus on what professional traders are looking at when they're trading the currency markets. And the core fundamentals come down to 2 key factors: central banks and interest rates, and the government bond market. So let's look at central banks and interest rates. Central banks use interest rates to control inflation around their targets, okay? In most advanced economies, they have an inflation target of 2%. So how does this work? Let's start off by looking at higher interest rates. If central banks predict that inflation is going to go above their 2% target, they're going to raise interest rates. okay? And the reason they do this is because if they raise interest rates, everybody's mortgages, credit cards, car loans, student debt, personal loans, these interest payments on a monthly basis are going to go up, squeezing consumer spending because people can't afford to spend money, causing the demand for goods and services to come down, and it brings down prices back to their 2% inflation target. Now, what you'll notice in all the financial news headlines is that when the markets are predicting the central bank to start raising interest rates, currencies always start to go up in value. Now, there are two key reasons why higher interest rates always support a currency to rise in value in the forex markets. Number one is the government bond market. When central banks raise interest rates, this forces governments to have to pay more interest on government bonds. So, what are government bonds? Let's say the Australian government needs to borrow money because the taxes they collect are not enough to run the economy. So, they're going to issue bonds and try to raise money by borrowing money from investors. Now, an investor can buy the bond off the government and earn interest on the money they lend, so they can make a profit. So, if Australia's central bank was to raise interest rates because they're predicting inflation to go above their 2% target, it would force the Australian government to pay more interest on their government bonds. Now, let's say you're a US investor and you see interest rates are going up in Australia, and Australia's interest rates are higher than the United States interest rates. US investors are going to think, maybe I should sell my US dollars and buy Aussie dollars and park my money in the Australian bond market because I can get more interest for free from borrowing money to the Australian government. Now, this explains why the Australian dollar went up in value against the US dollar by over 75% between 2009 to 2011, because Australia's interest rate was 5% higher than the United States. And this explains why pension funds, insurance companies, and bond investors are selling US dollars, buying Aussie dollars to park their money in Australia and earn free interest, causing the Aussie dollar to rise in value. Now, the second most important reason why interest rates drive the value of currencies is a strategy called the overnight carry trade. Now, this is the most important strategy that hedge funds use to make money in the currency markets, and you'll always see this all over the news headlines. So, how the strategy works: when you sell a currency like the US dollar in exchange to buy a currency like the Australian dollar, you can earn free interest every day you hold this trade open in your trading account. But the secret to this strategy is you need to make sure the currency you buy has a higher interest rate than the currency you sell. And the bigger the interest rate difference between the two currencies, the more money you get credited into your trading account every day you hold the trade open. So the wider the difference in interest rates between two countries, the more hedge funds are going to pile into the currency with the higher interest rate so they can earn free interest each day they hold the trade open. This explains why the Australian dollar went up in value against the US dollar by 75% in only 2 years. Now, let's look at lower interest rates and how this affects the currency in reverse. Now, if a central bank predicts inflation to go below their 2% target, well, this means the economy is slowing down. Now, what the central bank is going to do is they're going to cut interest rates to give people more money to spend. Okay, now the interest rates on mortgages, credit cards, car loans, student debt payments are going to go down each month, and now they can spend more money and help the demand for goods and services to increase, causing economic growth and keep inflation around their 2% target. Now, let's look at how when a central bank cut interest rates, it affects government bonds and how this affects a country's currency. So remember in our first example, when interest rates in Australia were going up and it caused investors to buy Australian government bonds and the value of the currency went up. Well, what do you think happens when interest rates go down? Investors who already own government bonds in Australia don't want to be owning government bonds moving forward because the value of these bonds are going to drop. So they sell their Aussie dollars back into US dollars and they look for somewhere else in the world to park their money to try to get higher interest. And this explains why in 2012, after the Aussie dollar had gone up by 75% against the US dollar, as soon as the Australian Central Bank was cutting interest rates, investors was getting out of the Australian bond market and they were selling their Aussie dollars back into US dollars and then looking for somewhere else in the world to park their money to get higher amounts of interest. And remember the overnight carry trade, which hedge funds were piling into to earn that free interest when the Australian Central Bank was raising interest rates? Well, what do you think happens when the Australian Central Bank is cutting interest rates? They are no longer getting paid all this free interest into their trading account. And as the Aussie dollar goes down in value, they want to quickly get out of the exchange rate to lock in their profits. And hedge funds start to sell the Aussie dollar back into US dollars to lock in their profits and get out the trade. And now you know why interest rates drive the value of currencies. When central banks are raising interest rates, currencies go up in value. And when central banks are cutting interest rates, currencies go down in value. So I hear you saying, okay, Kai, and I get it, but how am I going to use this to build my strategy? Well, let's take a look. We need to understand the importance of forward guidance. Now, forward guidance means what are the markets predicting for interest rates? Because if you can predict where the markets are expecting interest rates to go, well, then you know where the money's going in the bond markets and where hedge funds are putting their money in the currency markets. So how do we accurately predict what central banks are going to do with interest rates? So what I'm going to do now is introduce you to the most important economic data that helps you understand what interest rates are going by central banks and what professional traders are putting their money in the currency markets. Remember, central banks use interest rates to control where they predict inflation is going next. So we need to know what economic data the central banks are looking at so we understand whether the economy is expected to grow, inflation, or contract, deflation, and whether the central bank is going to raise interest rates or lower interest rates, affecting the value of a currency. So we need to focus very closely on something called leading economic indicators. And this economic data predicts where the economy is going, okay? And there's two types of key leading economic indicators: business surveys, which are manufacturing PMI and services PMI, and consumer confidence surveys, which tells you whether consumers are expected to spend money or not spend money, which will drive inflation. Now, what we don't want to do is trade economic data which tells us where the economy is today, because it doesn't predict anything for the future, okay? Now, these are called coincident economic indicators, all right? They may cause one-day moves in the markets, but they don't create trends because it doesn't predict the future of inflation. Now, these key economic data releases are things like employment and inflation. And the last set of economic data you want to stay well away from is lagging economic indicators. Now, the key word is lagging, okay? And it means it lags the economy, so it's backwards looking. And this is data like GDP, which comes out every 3 months, and it tells you what's happening in the economy for the previous 3 months, and it's not forward looking. So we have to ignore this data altogether. Right, so now you've got a solid foundation. You understand exactly what drives the value of currencies. You know exactly what type of economic data to focus on. So let's start to build out your strategy trading process. Step 1, we focus on leading economic indicators. That helps us predict whether the economy is expected to grow and experience inflation or contract and experience deflation, because we know straight away what is the central bank likely to do with interest rates and where are investors likely to put their money in the currency markets. Step 2, we use something called break-even inflation rates. This is a calculation that professional traders use to know the exact rate of inflation they predict over the next 1 to 3 years. So you can see whether inflation is expected to go above the central bank's target, whether the central bank's likely to raise interest rates, or if inflation is expected to go below the central bank's 2% target, and if the central bank is likely to cut interest rates. Step 3, implied interest rates. Probably the most important piece of the puzzle. We can see the exact level the markets are predicting that central banks are going to take the interest rate to at upcoming meetings. Now, this is absolute gold for us because we can see what one country's central bank is expected to do over the next 1 to 2 years of interest rates. We can look at what another central bank's interest rate is expected to do over the next 1 to 2 years, and we can start to match them up together and see, is one central bank going to be raising interest rates more than another central bank, or are they going to be cutting interest rates? Because we can start to see where we can generate high quality trade ideas, because now you know where are the bond markets going to put their money and where are the hedge funds going to put their money with the overnight carry trade. and you're gonna start to get some high quality trade ideas. Step 4, we want to identify the currencies with a wide divergence in interest rates. Remember, we wanna sell a currency with a low interest rate and buy a currency with a high interest rate, because you know that's where the hedge funds and bond investors are putting their money, so you can catch big moves in the currency markets. Now, whatever you do, avoid trading currencies that have similar interest rate levels, because you're not going to see big moves in the currency markets, and you'll miss the currency moves that happen when currency pairs have wide differences in interest rates, because that's where you're going to get the most volatility in forex pairs. Step 5, how can we make sure that we time our trades with the professional hedge funds? And believe it or not, there's a COT report that comes out every single Friday, and it tells you the exact amount of contracts hedge funds have open to buy a currency or selling currency, so you know if it matches up to your fundamental trade idea. Step 6, risk management. Before you get in a trade, you need to make sure you protect your trading account. So we clearly identify how much of my account do I want to risk? 5%, 10%? No more. How much does this currency pair fluctuate on a daily basis, a weekly basis, or a monthly basis, so I know where to place my stop loss? Next, where do we place our take profits? Well, we use something called risk reward ratios, at least a 3-to-1, which means you can win only 30% of your trades and still make money. And last but not least, we use the volatility and the stop loss to work out our position size to make sure we don't go over our predetermined risk, 5%, 10%, whatever it is you decide before you get into a trade. Step 7, trade management. If I'm in a trade and I get into at least a 2-to-1 risk to reward profit, I can start to roll my stop loss and lock in profits. I only ever enter into a second position if I'm clearly in a 2-to-1 risk to reward profit. Step 8, key mistakes to avoid. Number 1, don't be looking at the charts all day. If you trust your fundamental analysis, you let the trade run and you give the markets time to breathe so you can make your profit over the time period you're deciding to trade. Next, do not get emotional if your trade goes into a loss. Once you place your stop loss, never start to move your stop loss. If it hits your stop loss, you get out of the trade. Do not jump back into the trade straight away. Look for another trading opportunity. The next key point, don't throw risk management out the window and expect to get rich on one trade. Remember, we're trading to grow our accounts slowly with confidence, based on secure risk management. So everyone, the information on this free course genuinely has the power to completely transform your trading results for the better. So I hope you guys went through all of this, took a bunch of notes, and got some real value from this. Now, at this point, you literally have 2 options moving forward. You try to implement all of this yourself, spending time, money, and headache trying to figure this all out step by step, blowing accounts along the way, and all of the problems you will 100% face if you're doing this for the first time. Or get help from a trader that's already helped hundreds of traders master the art of fundamental analysis, because this proven system that I've given you is going to solve all of the inevitable problems that you're gonna face so you get this right for the first time. And if we're being honest, if you're not already 100% profitable, you definitely need help. So this is all for you if you want to avoid doing this yourself and get the expert guidance to make sure that you master the art of fundamentals. So guys, if that's you, click the link, check out the course details, and I'll speak to you soon. And thank you for watching.